Welcome to our High Rock monthly video for August. Today we shall address how financial markets performed last month and how this may impact your portfolios in the near term. We'll update you on any key adjustments to our models and special mandates and how our managing risk first will be the key to maintaining growth in uncertain times. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, celebrating our 10-year anniversary last April. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. Well, let's have a quick recap of what happened in July. Not a significant amount of change relative to the beginning, but there was a bit of volatility through the month. Nothing as much as we saw earlier in the year. Paul, I don't know if you have anything specific you want to comment on, but generally balanced portfolios were slightly better. And that was led to a large degree by a rebound in US equities and even Canadian equities for that matter. But international equities were underperforming throughout the month of July.
Yeah, that's the real standout, as everybody can see on the chart. And quite frankly, that big downdraft came right after they signed a so-called tariff deal with the USA. So that was pretty interesting. I mean, back in the winter, spring, US equities were underperforming, international were outperforming, and certainly over a 1 or 2 week period, the opposite occurred. So I guess something else we'll talk about maybe as we go through the individual models is government bonds. As we can see, Canada bonds are kind of underperformed all month. We'll maybe talk about that a bit.
All right, so let's just talk about how balanced portfolios performed on average. We use this Morningstar data as a comparison for your portfolios. So we certainly want to have conversations with you when you look at your portfolio and wonder how it is performing relative to the averages. So on average, year to date, balanced portfolios are up about 4.25, and that's a little over halfway through the year. So we can't extrapolate forward necessarily, but it's not a bad start, relatively speaking, after what we experienced in the early part of April with the big downdraft in equity markets. 1 year, 3 year, 5 years, again, longer term, we start to look at things and look at them in terms of what kind of risk we're taking. So the average Morningstar 5-year balanced portfolio returning 6% with a 5-year standard deviation of about a little over 8%. The return relative to risk taken is about 0.75%. I think most clients of ours in their balanced mandates would recognize that their portfolios return relative to risk is closer to 1%. So there's a bit of comparison, but again, everybody's portfolio is slightly different and depending on your strategy. So we're always open to having those conversations. And to take it one step further, how this translates into what we saw in the recent volatility. This is a pretty good example because sometimes it's difficult to grasp all the risks in your portfolio and then understanding the complex moves in markets or the standard deviation, which are very important factors that will impact your portfolio and as a result your wealth. And remember, the goal isn't to avoid risk, but to understand and manage it wisely and seek out those who can build the appropriate strategy to get the best possible risk-adjusted returns. We think we can do a significantly good job at that. So in this example, really imagine a $1 million portfolio that is pure equity or equity correlated. in April, seeing it take a significant drop, close to 16% or $160,000. Nobody wants to see that in their portfolio, especially over a very short period of time. So when you look at the balanced portfolio with less stock market correlated assets, you can see a very limited downside move in April and May, which allows the portfolio to bounce back much more quickly and get back to growth much more quickly, as the S&P 500 and equity correlated assets take longer because they've had such a significant down move. So these are what we're trying to this is what we're trying to accomplish with client portfolios, is to mitigate that downside, which gets us back to growth faster when we see markets start to correct again. I don't know if you've got any comments on this, Paul.
No, it's a great chart and good explanation, Scott.
All right. Well, again, as always, we do want to focus on our your long-term goals and your plans, and we want to make sure that they're in line. And we're here to continue to have those conversations, and all you need to do is get in touch when you're ready to do so. If you don't get in touch in the near term, we shall be reaching out to you as we get into the fall and start to talk about the end of 2025 and what's going forward for 2026. Our global equity strategy at the moment is to rebalance a little bit back to cash after we saw such a sharp move higher after the sell-off in April. So not a lot going on really at the moment, but our tendency for the global equity strategy is to take, if as we rebalance, take profit off the top and rebalance back to even weight in the equity model. Paul, any conversations around tactical strategy? You might be on mute.
I am on mute. No, I am not. In tactical, we did made one new investment. That was in Baytex Energy bond. We bought this bond at roughly 8 3/8 yield to maturity, yield to worst. Excuse me. And we do own the stock in this company, but we added a bigger position in the bond. And the reasoning behind that was the company was at a energy conference in Calgary in early July, and they basically stated that they are going to pause their or decrease the amount of shareholder returns through share buybacks and an increasing dividend in favor of paying down more debt. So this bond we bought is a 2030 bond, which is still fairly out there. It's 5 years to maturity, but it's a pretty big nut for the issuer, for Baytex. So in fact, and we ended up being right, during the second quarter, they bought back, I think, 41 or 42 million US. This is a US dollar bond. So they started buying this bond back. And the second reasoning is just in general, and certainly worked well in our high yield strategy, is these energy companies, of all the ones that I analyze and track, Baytex is probably the most leveraged of all, and its leverage is only at 1.1 times. Just to give you an idea, the average high yield non-energy company would be at 3, 4, some out at 5 times, which is getting very high leverage. So really what that leverage tells us, that low leverage, is their balance sheet is in great shape. And the fact that the company wants to pay down more debt is supportive. So that was really one. The other comment in tactical, excuse me, is Source Energy, which is arguably our largest, for most folks, our largest single weight in the tactical model. They reported their second quarter results on the 31st, And within there, the stock it bottomed out at, I don't know, 6.75 back in April, and got up as high as 16.24. The absolute peak is around 18.5. Got up to 16.25 and on the 30th, and they reported on the late on the 30th. The call was on the 31st, and they did add a note of caution in their commentary for the back half of the year, and the market certainly took that as somewhat weaker. And the stock sold off to the 13 range. So this stock is, I've said it before, Scott, it's extremely volatile. Having said that, I did have a conversation with the CFO after the conference call, and my sense is that they are erring on the side of a little more cautious, but they probably want to under promise and over deliver. I just don't. I went through my model. I went through all the forecasting with him, and quite frankly, they look like they're going to perform and certainly meet the expectations that I had in my model. So I just don't see why the stock would be selling off a ton, other than the fact it is volatile. They need to get out and market and get fresh eyes and new investors looking at it, which I suggested he do. That's about it for the tactical, Scott.
Okay. And over to fixed income.
Yeah, fixed income. I said I'd talk a little bit about government bonds, and I just talked about Baytex Energy bond at 1.1 times leverage, which is, if not, well, certainly the highest leveraged oil company that we follow. You know, and I had a meeting a couple weeks ago with a guy and said, well, credit spreads are really compressing. That is true, but there's a reason for that, because quite frankly, I'd rather own a energy bond in Canada than a government of Canada bond or a US Treasury bond, given, I think you mentioned it, Scott, or certainly we will in our client note coming out shortly, is these both Canada and the US, and quite frankly Europe, but the amount of annual deficit financing and the accumulated debt that has built up is stunning. And it leads to a path of inflation. I think inflation will have a very hard time going down, but the bottom line is these sovereign bonds, Canada and the US, are less creditworthy than they were previously. So, I'm not sure we need to be rushing in to buy government debt. And if you look at the pie chart, moving over to the preferred shares, which we don't own a lot of in the fixed income model, but these rate resets, if interest rates are going to be stubbornly high in and around this level, the rate resets are actually look pretty good. So we actually may look at altering our preferred shares within the fixed income model. High yield performed quite well on the month. Investment grade bonds a little less so. Special mandates, again, I just mentioned high yield performed pretty well. We've said it in our commentary to those investors who are in that mandate. It should be a decent coupon year, i.e., we're going to have less capital gains and more interest income to drive our overall performance. And that is the case. And again, these oil and gas energy bonds are much, much more stable than they were, 5+ years ago, back into the 2015-2020 period as well. So, you buy a bond at par and you're collecting 7-8% yield to maturity. And it stays at par and doesn't drop down to 80 cents and go up to 105. That stability is a nice steady Eddie performance for us. So we're happy with that. As I mentioned, preferred shares, and Scott, you showed it on the chart, but these rate resets have done well. So our preferred share mandate continues to do quite well. A lot of that And we just had notification yesterday on an Enbridge pref, a non-bank. The banks have redeemed roughly 8 billion over the last year and a half of preferred shares out of the market. 8 billion. That is a big number. And non-banks have done so as well. Enbridge just did 2 nights ago. Or yeah, I think 2 nights ago. And some insurance companies like Fairfax and non-banks have been redeeming as well. The market is shrinking, and there is clearly still demand. If rates don't go crashing lower, then that market is still going to be pretty stout. So that covers both high yield and preferred shares.
All right, that's great, Paul. And just for edification, the fact that your high yield mandate doesn't have significant volatility, the relative return, the risk adjusted return, the return relative to the standard deviation, as we were talking about before, in the high yield mandate is running at over 2%, which is a pretty decent return relative to the risk taken in what we would consider pretty and more potentially volatile times, right?
Yeah, I mean, it's been A, great performance, B, great risk adjusted performance, i.e., how much return we're getting per unit of risk taken. These are, equity, I don't want to oversell it, but equity-like returns with far lower volatility or risk. So it's been good, and a lot of that has come through our overweight in energy bonds over the last 5 years.
Yep. Excellent. Great work on that.
Thank you.
All right. Well, that's it for August's August's video. As always, we want to thank you for taking the time out of your busy schedules to join us on this call. We'll be back with our next update at the beginning of September. So until then, on behalf of my colleagues, Paul and Diane, we want to wish you all the very best for the rest of the summer.